Okay, let's get started. So let's go over to what we actually are seeing with the SPY here. We have basically started coming down to a bottom area over here. Off of the older chart, you see where we had an old dark pearl print that came in. This is a one from say probably a couple months ago. We based off of that old print right there. So price has memory. This is where that they were playing around with a few months ago. So they're using that as more or less their respect. We did pull down all the way down to 285.39. If we basically broke the 285 to 284 889 right around here, so let's just say 285 flat, we would have broke this area right here. That would have been 100% gap fill off of this drop that we had back in October. This run up, this measurement that we've been playing right here. We've been doing this pullback. So this is basically our impulse leg that we've had, our major one that we've had. We've had a larger, bigger picture than this, but this is the one of the bigger ones because we had this big dip and push. We had another one, with the dip and the push, but obviously we broke through those levels, so this one becomes invalid. All these little smaller ones become invalid. And so we have to go back to as far back as we can in order to do it. And you can also see where we had some stabilization back over here. So this makes a little bit more sense to be measuring off of where we're actually going to see pullbacks happen. So being said with that, 100% gap fill would have been right basically the break of this level right here from October and doing that within 5 days. And by going that far back, where would our next level actually be? Well, we would have had a little bit of a slippage on a projection on the downside off of this measurement here. That's the yellow lines are all basically everything from this point to this point. The um, orange lines are the larger, bigger picture. So let's go out to the larger, bigger picture and see how far back we're going with that. The major dip that we have over in this area. So with this major dipping area and this pullback zone, where do we actually have room to come down to? Because what are we actually pulling back off of this level here? You can actually get rid of this now because this is becoming invalid. We're basically at 50% level, give or take, a little bit. Depends if you're looking at pre-market data off of this area here, or you're not looking at pre-market data. So if we don't look at pre-market data, we can move it up here to this point and just do the actual daily data, since we're basically looking at the our Santa Claus rally that we had back then. The 24th is when everything started reversing. The 24th of December was basically the last low day we had before we had the rally back in 2018. We came down to 50% level off of this dip going off of the daily. Okay. So the next area of a run down for support would obviously be 61% because we're only at 61%. So we're looking at 270, 374. The 272 I was calling out yesterday was because I was actually taking pre-market data into account over here because I zoomed into this area yesterday and started looking at, you can't do it off of a daily chart, but you can go out to like a 12-hour chart and kind of you can still get the pre-market data this far back. You have to stay within your hourly chart range in order to be able to do that. But being said with that, we're still looking at a pullback to 273 with the break of the 50%. Well, we're basically coming down and bouncing. We're way, way overextended on the SPY at this point. We broke the 200, which is dangerous. We did that a day ago. We're not having any crossing happening with the 50. We're still far away from the 250 crossing. And this crossing of the 200 and the 50 SMA daily levels, that is where our institutions start getting worried. That's when they start going, you start seeing, doom and gloom that's even worse on CNBC than what they've been portraying the last couple of days, because that's called the death cross. And that's where basically we start looking at total reversals of markets at that point. Right now, this is just a correction. We're just basically correcting off of back from the big run up, which we've never really had any major correction from this point. Have we got any lower low points? No, we've basically been holding a trend the whole time. So if you look at this, like if you're looking at an intraday chart and we ran from the low of the day to the high of the day, wouldn't we be expecting this type of a pullback on our intraday charts? Well, daily charts are not any different. It's just that it takes a lot longer for it to take effect, but our downside move is always faster than our upside move when it comes to pretty much anything. But when it comes to daily, it's really when you can see the big picture of that actually taking effect. So anyway, we're looking at this basing right around, let's say just 275, just make it, easy. Right around that 275 area is where we're looking at coming down whenever we have a major problem with probably the outbreak, with possible room down to the 255 range. Whenever, I guess you could say, shit hits the fan. I mean, this is when this is going to be the ugly area that we're going to see in the market once we start seeing some seriousness that comes into places. Right now, we just got the fear happening, but we haven't actually gotten the outbreak yet. So if we hit the outbreak, you can expect pullbacks in the market in this area, because we start seeing stores, restaurants starting to shut down, schools shut down. People are going to be staying at home more, especially as schools start shutting down. Parents are going to have to take care of their kids more. They're going to possibly be sick. They're going to be staying home more. Employees are not going to be coming to work as much. People are not going to be going out as much. And we're going to start seeing a cascading effect of economic problems, especially for the small business owner that won't probably get any type of government subsidies or bailouts because of this problem. Anything major like this, the government's probably going to step in and give some sort of kickback on the taxes, at least. Hey, were you part of this crisis? On your tax return, you can write it off and stuff, kind of like how they do if you had major theft or fire, or you have you're part of a disaster relief area or something like that. We can kind of expect the government's going to at least kick in a minimum of that point if we ever get to the point that the break is. But so small business owners will get a little bit of a tax break and stuff, but they're not going to be getting any type of possible help protection other than the companies that are too big to fail that are going to be massively affected by this. So, because we've seen that in the past, when the housing crisis. Being said, we are starting to see some leveling off in this area, because, we had the old print that came through. And then yesterday we saw more traffic than normal come through off of the SPY, off of these records. So if we go and zoom into where we are yesterday, we're coming down to our basing level and how we were starting to pull back. We bounced yesterday 23% off of our rundown that we had basically from the start over here on the 19th, where our trend started flowing down. We're at 23% pullback already. Didn't seem like much, did it? But technically we are on the pullback that creates that sideways action if we don't get much of a rally. The whenever you see this, with stocks that are just tanking dramatically really fast, like in single day, like earnings misses and stuff like that, then you wind up getting the 23 and then it kind of flatlines. This is a little bit different type of an event where we saw the traffic coming in yesterday over here at the 297.89. 160. This is actually, so it's over 167. Actually, it was 168 by the end of the day. Prints come in total at that price point. Out of all those prints, we had about, I have to go back and look. I want to say we had about 36 prints come through that was in the that came through that are late, which means that they started reporting this information, started going through this information and stuff over here last night, and we just get 24 hours later the notification. So they started this early on yesterday, and we started trickling through with this. Normal prints that come through on any given day is considered 9 or less. We had 36 of them. Back here, we had 24 off of this major move. This 24 prints. So we're higher than we were back on this drop. The drop doesn't really look, measuring wise, it's not that much of a difference between this major drop versus this. And this is when the sky was falling all within 1 month. Everybody's thinking this is the worst December ever. You know, it took us pretty much the whole month to get to this point. We got to this in 5 days. So it makes sense that we were going to have a little bit more of an aggressive move off of that. So 36 prints came through that are telling us that they're trying to hide their position of what they're trying to do. This is the thing that we pay attention to the most. So we've had, I wouldn't say unusual traffic inside of the institutions with dark pools. We've had an unprecedented amount come through yesterday. So they have sold or are adding to their position. We don't know if they're buying or selling. All we know is that when we see the positions come in, that they are they're staging a setup. So I can be completely dead wrong with this here, guys. I can be completely dead wrong. They may be accumulating pressure here to tank us on Monday. I don't really feel that that's the case, though. I feel because we've been down so far in 5 days, we're overextended dramatically, which nature shows you pull a rubber band far enough, it's going to snap back. We can start expecting that snapback. We haven't gotten it yet. We're just starting to see the basing at this point. So we should, I hate to say the word assume that they are doing accumulation for the buy side off of this. Another thing that kind of gives me this impression is now the federal bank, the Fed as we call them, has stated that they are going to come out with something for relief. That is what the market wants to hear. These guys that are set in this position are tied in with these banks, because these are banks, a lot of them that are doing this. They have the insight of knowing what the Fed are doing. They got leaks going on over there. They got a head knowledge that, hey, in coming days, the Feds plan on doing this, are going to do that. So they can set up their position ahead of time for the major move. And this isn't retail here, guys. This is institutions that are doing this, and they're going to have the government insight. They're going to have the federal bank insight and all that, because they deal with the federal bank levels on a daily basis in order to conduct business. So we did have some traffic going into the final hour or so into the after hours traffic close of we started off pretty much after the close, started seeing 295, 45. We had about 40 more on top of the 161 prints going into the close. We had another 41 more prints that came in at 295, 45. That's what gave us the push. Okay. Then after we started settling down off of that, in the last hour into the close of the after hours session right here, we started getting, you see where we got these little legs that are coming down here? We started getting some prints that came in at 296.26, but only 10 of them. and we got some at 299.36, or excuse me, 299.35. Only 6 of them. So out of the whole big picture of the big run up, 168 of these things have came through. We've only seen 16 of them that could be potential profit taking, or they could be adding to the position. We don't know either way. We just know a transaction happen in that price point area. I mean, that's nothing compared to what they've ran all day. I mean, they literally have ran up over 200 prints between the session and the after hours traffic. So you have to have this, I guess, certainty, probability, I guess you should say, that I would say we're in the high 90% ratio of a bounce coming on Monday because of the pressure that's being built up. There are 3 possible scenarios with any type of play. We have, with this type of a pressure, really only 2 is the way I see it. Well, this could be 3. Is the rally, which makes the most obvious sense. But you see, we're watching a network here that the average retailer doesn't even know exists. They won't even, some people won't even admit and believe that there is a separate network here. And that's what's crazy about this, is that the people just don't. I mean, you tell them about this dark pool, it sounds like, oh, it's like cryptocurrency, or it's like this area that is like the you hear about the dark web. You know, you think, oh, this must be illegal activity and all this. This must be a something completely that's not right. It says, you must be crazy. What are you talking about? Conspiracy theorists and stuff. The thing is that, you know, when I first heard this myself years ago, I thought it was bullshit. And then I started researching it and realized this isn't bullshit. And then when I started watching the banks sitting in front of Congress, the special committees and stuff, and explaining about the dark pool networks, that's when you realize this isn't bullshit. This is really going on, that they actually have their own separate system in the block trade sector, and that they actually come in and they do massive amounts. And the purpose behind this and how this has been sold to Congress all these years is that if they come in with the amount of money that they're moving around in this network, it would basically scare off any type of retail or investment purposes. People would get an early insight of, oh my gosh, somebody's getting into they're getting into this thing and they're taking it down. This is the reason why we don't get reports of actual buy or sell. We just get transactions that the transaction happened. We don't know if they were buying or selling off of it. They technically are not supposed to know on their own network who they're buying and selling to. That's why they call it dark pool, because it's supposed to be more of an anonymous. It's just making a connection between 2 larger institutions that are playing out a card, you know, to work with each other. Who knows how well that really works out? But being said, we call it the dark pool because it's supposed to be an anonymous area where big money can move things around heavily. They have to report it to what we call our lit network. Our lit network is what we trade on as retailers. And they have to report within 24 hours, depends on where they're trading from. So if they go from New York to London, they have 24 hours to report because of the time zone difference. But they report if they're trading in New York or in Chicago, then that's completely different. They have about 3 hours or so that they have to report that they made these transactions. You know, so it's all the stuff coming through is either going to be live or it's going to have a delay. Most of it is delayed because they want to try to be hidden as much as possible to the lit network. So we can detect the traffic on it by certain things in there. And if you guys really want to follow, you know, this type of things in there, you can follow it with different type of services like Flow Algo, or you can go over to, you can go get yourself a free account with Charles Schwab. I mean, they're buying out TD Ameritrade, but Charles Schwab, You can go read the ticker tape on the exchanges over there, and you can follow what's happening with that. And that's basically what the majority of people do. And that's because that's the old school way of doing it. And that's just, way we've been doing it all these years. Being said with that, the bounce off of this level can be coming in over here because it's such a large amount that's coming through. Looking for pullback areas, we just need to trade it just like any other chart. We need to look at our first target being up here at 306 because it's a 38% pullback. We always want to take profits at 38%. We had a lot of dark pulls come in on Thursday at 311 and a half. Some of it was 311.80 something. Some of it was 311.56. Some was 311.50 flat, basically 311 and a half on average. We had a huge amount come through that also. I'm looking at that as being major resistance because of the amount of institutional traffic that came through. But at the same time, with all those transactions, we flushed down further the following day off of this transactions that came through. So it was Wednesday. It was 2 days ago. So we started flushing down and we had the massive flush. So this, I still consider major resistance because it has a history. They know what they did at this level. So it only makes common sense that they would take it up and take some profits themselves. So I would shave some off the table here with the market going into Monday. I'm honestly expecting a rally up to this area here and a curl off of it. And once again, we're at 50%, just like the big picture of the big move we had. Makes a lot of sense that they're trying to drive it up to the 50% level, but at the same time, just making it just slightly short of the 50% level because they know, we're going to have retail up in this area because they are using Febs and they see that. So cut it a little bit short before we get to the full 50%. And that's the way you should be trading anyway, guys. You shouldn't take profits right at the line. You should be always taking profits right before the line because you have a greater odds of being 100% right more than you would be if you waited to the line, because a lot of times you put it at that line, and if you're too far into the queue, you don't get hit, and it pulls right back instantly, and next thing you know, you didn't get executed, and you just lost all those profits. So you should never be too greedy and take it right at the number. You should always be slightly shy of that when you take your profits. But I'd like to see as a secondary the 61, just because it's a 61. And we see the 61 works so well. 50 is not usually a very good area that we see slow down. Usually once we get past the 38, we wind up going to the 61, and we just use this as a speed bump. That's why I'm putting secondary price target at 61. So more or less I'm saying is take some off the table. If we see enough aggressiveness on Monday, go ahead and push it up here, take majority off the table. If you see it breaking through and pushing higher, take everything off the table at this point or shave it way down. You start seeing the break of this line here, you can always add to the position and then push it up to the next level. Same thing as once you come up to this area, you can either reload after you take all your profit, or you could just shave off just slightly and add to your position if you start seeing the push up all the way back to the 78 before you get completely out. So for us going from here to the 78 tomorrow or Monday, a 30-point move, I have a hard time seeing that. I really do. I don't see that happening on there, because look at our average drop on 5 days that we've actually came down. Okay, we started really slowing down over here, and then we had the big drop. Okay, so this was Friday where the slow then. This is the accumulation pressure we saw them building up, and we got reports with the big drop. And we talked about it last Saturday around what was going to basically happen at the open. So here's our Friday traffic. We opened up Monday down here, just automatic, no trading. We couldn't trade it. Did we have a 30-point drop the next day? No. I mean, we had it off of the after hours. We had about a 10-point drop or so. Next day, we dropped from the 320s down to the 312s, another 10-point drop. And of course, we bounce a little bit, and the next come back down, and at the close, we were basically closed flat because of the bounce. Next day, next 24 hours, you could say we dropped from 11 to 300, another 10-point drop. So we can't expect the market to give us more than 10 points on the upside per given day if we only get 10 points on the downside off of it. Because going down has always been easier and faster than going up. So what makes a lot of sense around the 300 is, can we get 10 points higher? Yes, we can. On a very aggressive move, we can get the exact same amount that we had on the downside on the upside in one day. But what's realistic? About half of what we have been doing on an upside move versus a downside move, which is going to be what? Basically 306, 307, 306.99, 307. So a 7-point move is very realistic going into one trading day on Monday. Would a grind at this level and the following day a push up to this level? And the grind off of this one, and if we can get past that without any complications of any type of pullback, another nice little grind up to this level. So this is more or less how the expected stair step would be versus it being from here to here in one trading day. It's not very realistic, because if we can't go down more than 10 points on average, we can't expect it to go up 20 points in one day or 30 points in one day. Rallies are rallies, but they're not. Outside moves are always going to be less than a downside move. Because it takes a while for people to realize what's happening. Oh, we're bouncing, we're rallying up, we're going to come in. By the time that they realize that the game is on and it's reversed, they're already turning into a chase. We're also looking at more or less how are we holding our trend area right here. We're at the top of the trend line. So if we can get above that trend line on Monday, we get that pop and push. And this is where I still state that I could be completely dead wrong. They could be saying the hell with everything. We're building up a position to take this thing down to $73. Could be. But because the Fed's making their comments and stuff about what they're going to be doing, I think that changes the game to be more long biased than short biased, just because technically we don't have a full-fledged indicator for a reversal yet. We haven't broken trend yet. We're just going off the assumptions of this. So if y'all guys are completely blind to this information, would you really be thinking that this would be a possible dip buying opportunity to push up when it hasn't broken trend? Not really. You'd see accumulation of basing here and say, well, this looks like a pretty good basing. The break of this trend line would give me confidence to get into the trade as just a plain Jane technical trader, not paying attention to institutions. Well, we're over here getting in onto this thing early for the push, basically playing with the institutions right now. And when that trend line breaks, if the trend line breaks, what's going to happen with that? We're going to get a mad rush on the lit network to help push their agenda up. We're going to see everybody coming in saying trend is now breaking. We need to buy it, buy now, and let's ride the wave up. So we could get enough aggressiveness to get this far in one trading day. It's not out of the cards. It's just not very likely because of how much we've been downtrending through the process. But if we got enough aggressiveness, enough people seeing that the trend is breaking and stuff, and the pressure point busts, then yes, it's not out of the cards. It just has a low probability. The high probability is to make it up to here on Monday for the bounce. If we do not get a significant push Monday morning, then you can expect the sell off to occur off of this and pull back. This is going to have to happen pretty early on in the morning. I would not be surprised if we wake up Monday morning and see that we just gapped up and they didn't even give us an opportunity to even get into the trade. Yes, could be another possible, because what did they do here? Closed here, gapped us down. Could you trade that? No, not unless you were into it early. You missed that move. Close, open, gap down, miss the move. Miss the move. So, yes, they can open it up at this price point Monday also, just as easily. Now you talk about some manipulation going on here, right? That's not fair. They didn't give us an opportunity to get in. They knew what they were doing. They're opening up already here, and we come in as retailers going, wait a minute, it's already at that point. I can't trade that because it's already opened here. Well, maybe people may start chasing it up to here on Monday if we opened up over there. Anything could happen. We're in historical times. Anything could happen here. So, and this is why you always should make sure you keep your risk when you're trading these things in line with how much you're willing to lose off of this, because this is basically, we're putting a bet down to see if this works out, because we're working off of, predictions of where we think things are going to go, probabilities of how it can play out. So the safe bet on this to be profitable was to be having a position into the close yesterday just for the pop, because of the gap potential of them opening us up higher. And that's the biggest reason why, not because we see them coming in, is because they have a history of doing the gaps from one time to another, and you miss all of that amount. The risk is that we're at the top of a trend line and they're accumulated it, and if something really negative comes out this weekend that just says doom and gloom, we have a massive outbreak or something, all of a sudden, boom, we start flushing, at least to the bottom of our trend. So I want to see us rally back up. I think we've gone way down, too low, too fast. We're within the parameters of a move 3 to 4 times in history that this has ever even somewhat occurred as far as percentage wise moves. We're within the 1933 market movements, the 2000 movements of the .com. We're in there with the 2008 crisis, and we're actually exceeding some of the levels of 2008 already on certain things. And we're getting closer to more of the information that happened during the original market crash back in the 1933 and stuff like that. Major market moves like this have only happened about 5 times in history, like when World War II started. So this we're in historical times right now here, and anything can happen. But we have to trade the stocks and everything logically, just like any other stock. We have to look at it as where this is just another day, just a bigger chart. That's all it is, and play what you see and put your risk on the same accordingly. This isn't a time to go and load the boat and say, hey, I'm going for the lotto play. Even though this is probably one of the best opportunities actually seen because of all this information of the probability that this is going to be something that works. But this is also the thing, is that if we interpret this information wrong, that you could blow up an account. So you should never load the boat, even if you have you're almost to 100% certainty that something's going to happen, because you're never certain. There's always the possibility something can take place that could screw you up. So you always need to basically always keep your risk management the same, no matter how certain you are or not, as far as it going into what you're willing to lose off of it. Because it makes a difference as far as if you are going to be here for long term or not. Because trying to hit home run plays, you'll hit them every now and then, and you'll make a crap load of money on them. But will you be playing in this game 10 years from now, 5 years from now, 3 years from now? Most people that shoot for the fences wind up burning out quicker than the guys that just go for those base hits and get those occasional home runs off of their base hits. And that's the way you need to stay as a trader. You need to stay consistent, just saying, hey, this is just another trading day. I'm just going to take the price action as I see it and stuff, instead of trying to say, hey, I'm in historical times. I'm going to take advantage of this situation, because if you're wrong, you may not be here tomorrow. You may be the guys back in the 20s that, were falling apart with their businesses and stuff because they overextended themselves off of leverage and stuff like that, and just got to look at it in that aspect. All right, y'all guys got any questions? Let's start talking about them and stuff.
I had a question about divergence. With the oscillator, one of the rules is it has to be a new low or a new high. On one of those peaks, does it matter which peak is the new high or the new low? You know what I mean?
On the oscillator itself?
Yeah.
Which time frame you're looking at?
Doesn't matter. I actually posted it before. I'm trying to find it, but when you're looking at your oscillator, so like right now, if you look at your, which one do you call that one? Consolidated inversion trending. What is that one right there?
This one?
Yeah. When you measure the peaks, so like right now you have the low of the day or the low of the daily chart as a new low. So does it matter if you're measuring? It's kind of hard to explain, I guess.
Well, this consolidation I'm using. This is the ADX on top that's white and blue. Behind it is the stochastics, the regular stochastics.
That's the word I was looking for. The stochastic. Does it matter which peak it is? Because it's one of your rules you said in divergence that you have to have a new high or a new low. Does it matter if the peak behind it is the new low or not?
The peak, this one here?
Down. Yeah.
Like this is
not,
ADX.
Not the ADX, not the ADX, the stochastic.
Okay, that's down here. Okay.
So what if the new low was at the other low peak? So on your stochastic right there, that where the daily's low is at. Where we're currently trading.
This right here.
Yes.
Okay.
What if the new low was actually the other low peak? Would that matter as far as divergence? Your second low peak right there?
I use this right here, not for divergence. I don't use this point. So when we're looking at more or less divergence, we need to basically be looking at the actual trend. So where we're kind of basically looking for a trend right here. Mm-hmm. And then on the high side, you're going to have the same thing, which we don't have anything really on the high side because we're pretty much flatlined right here across the board on all these.
Yeah, I understand that. But what I'm getting at is that in your rules, to actually have a divergence, you actually have to have a new high or a new low. Right now, we're measuring the new low.
Right.
Does it matter that the new low is on the current time frame peak or the second time frame peak? So the second peak right there.
You talking between these two lines? Or are you talking about the peaks here?
Those two peaks, yes. That one and that one, and the very first one. Does it matter where the new low occurred in those low peaks?
Between these two, no. Because this is a cycle. No.
That's the first one where you're at right now. That's our current time frame. The second low peak. Does anyone else understand what I'm saying?
I'm having a hard time following you here, Mike. I'm sorry.
Yeah, I'm just seeing an oversold stochastics and that
I'm
kind
not
of stuff.
seeing. Yeah, I'm not seeing divergence here at all.
I'm not saying it here. It's a bad example. Let me find it. I had posted this in the previous one, and I never got to answer it. And now I'm trying to find the post. Does anyone else have any questions? I'm looking for this.
You got me intrigued. And
I gotta find the old.
well, then yes. Could you define divergence?
That's a whole nother class.
That's a whole nother class. I mean, that'll take hours to go through.
Hey, Darkside, I'm
We
looking
will
at the
go over it
QQ.
though.
I'm looking at the QQQs, and I think it came right down on the 200. I mean, that would be a pretty significant thing. And then the stochastics are already, the white's already crossing the red there. That's a pretty strong indication that it's setting up for a reversal. Wouldn't you agree with that?
What time frame are you looking at?
Daily.
Well, I look at we're at the 200. I was keeping a kind of an eye on this yesterday with the Qs also being at the 200 for the bounce. And so this is going to be another thing a lot of people are going to be looking at if they use the 200 SMAs. They're going to be saying, oh, we're at the 200, we're bouncing, obviously, why this is happening. Could be another reason why the institutions are building up to a certain degree, because they do prints on the Qs. I just don't follow the Qs as much, because if you look at the Qs versus the SPY, it just doesn't have the same range that per se. It has less dark pull prints. It's traded less. I mean, this is like going from like, I don't know. It's kind of like there's a big difference on the traffic that's between the Qs versus the SPY. That's the reason why I don't really pay that close attention to the Qs, because the Qs is basically NASDAQ. The SPY is the top 500 tickers out there.
Gotcha. Yeah, because I mean, what I noticed, like prior to the drop, when the Qs were still pushing, I mean, the SPY was actually kind of consolidating, looking like it was curling over when the QQQs were actually still in an upward trend. It looked like.
I would say that 95, 99% of the time the Qs follow the SPY, just because majority of the heavy hitters in the Qs are in the SPY. When you start, every now and then you will see a little differences, but see the SPY do something that the Qs don't. And that could be from because of other sectors coming in. I mean, like, for example, you could have Caterpillar, which is a big ticker in the SPY also. Big ticker in the Dow, because they've been around so long. They can make a major move, and you may not see the reflection in the Qs because Caterpillar is over on the NYSE and not on the NASDAQ. Now, you may see a slight delay to that, because when there's a major move in the Dow and a major move in the SPY, the Qs will usually follow suit because that's NASDAQ. And so you'll start seeing other tickers that are part of the SPY move with it on sympathy, more or less, as the market's moving. Like you may see Facebook or Apple start moving around a little bit because the market in general is kind of moving, and that will help move the Qs along with the SPY and stuff. But my main focus is the SPY, because that's where we see majority of the institution prints come through and everything. We don't see hardly anything on the Dow. We see traffic on the Qs, but just not as heavy amount of traffic. I'd say maybe a quarter of the traffic goes to the Qs compared to the SPY. We also see it on the Russell too. I mean, Russell's something you pay attention to for small cap, but it's got less traffic on it also that comes in for day per day. So that's why the main focus is on the SPY. That's why majority of the bigger traders pay attention to the SPY and not the Qs per se.
Okay. Yeah, and one other quick thing though, on the daily for the SPY, from the overall trend from its previous low to the absolute high, when we had that correction, I guess see if I can scroll back and find out. Anyway, we're at that 50% retracement. I mean, how much of an area do you think if we hold that area and then use that as a bounce spot? Because I mean, fibs usually hold their 50%. It's pretty solid, correct? Use that as a basis.
The 38s are usually the first area of line of defense. Usually when we get to 50, 61 is inevitable. Normally 50% is not even a fib.
So you think you could test the 61?
Yes, I think we were kind of
Gotcha.
going down to the 61 if we get an outbreak. I think we're only bouncing because it's 50%.
Right.
Even though we put 50% on Fibonacci's, it's not a Fibonacci number if you really look at the rules. It's just 50% of a pullback, and that's why it's respected, because it's half of the run. But it's not part of the ratio.
Gotcha.
61 is the golden ratio.
And that's for major extensions, like if there's a major move or in one direction or another, it should always come back and kind of retest that area before a next leg up or next leg down.
As far as which fib or which direction?
The 61. Like if you have a major move in one direction, you think
it's
overall,
not guaranteed.
Gotcha.
23 is guaranteed.
Okay.
Because that's going to be the pullback, and that's a potential continuation. 38 is going to be where we start seeing patterns. We can't do the harmonic patterns we do. We have to have a 38. There is no pattern that is a 23. They're all 38s and down in numbers or up in numbers. So for major pattern purposes, we have to have a 38, and that's why we see the 38 so much, is because we're starting to develop into a pattern ratio. And of course 61 is that's the sweet spot of anything. That's the preferred area that everything needs to be at for a bounce, continuation, and so on and so forth. But because things change in the market, kind of like how the lockdowns have changed over the years, where we used to have sell-offs when the lockdown expiration happened and stuff. Now we sell into it and then we kind of flat. Things change over time, and the systems are more programmed to 78 than they are at 61. 61 is respected highly in the industry for bounces, but because it is more of a known factor, a lot of times the algorithms will pull you down to the 78 more so than the 61, just because they're trying to shake people out with that last little pullback. Because people are starting getting out to the point of thinking, well, it's gone down too far. So 78 is really your line in the sand when it comes to if you're going to be able to reclaim or not. Because once you start breaking that, most stocks have, if they get a bounce, it becomes not 100% gap. It may go up to the 61 after it drops down below the 78. But
Okay.
if you're at the 78, you have potential of doing 100% gap fill plus still. But your strong pressures happen for continuation purposes, and usually for not breaking trend is usually the 38 is usually the point that you can still bounce within a trend line normally and still have room to kind of move. Once you start breaking the 38, now you're probably breaking trend normally, because what if you pull back 50%? 50% is half of a run, which means that your trend line has probably been has been seriously compromised. So you're going to have that pullback at that point. And so 61 is usually the preferred target for a sideways action. And once you hit the 61, a sideways action platform would have coming down to here is a bounce, not bouncing between the 61 and the 50, but a bounce between the 61 and the 38 back and forth. Usually you get like every other on the fibs when you give your bounce sideways action. That's where the 50 becomes kind of like your basing middle point of your basically your sideways channel that you're creating.
Okay, cool. Thank you.
Yeah, so on this topic, can you look at RVNC? Is it making a C to D leg now? Because it sat right on that 38.2. It did the pullback. Is it ready for a C to D leg?
What time frame are you seeing it at?
Daily.
I'm not seeing really a C to D leg. I mean, unless you're talking about up here for the bullish pattern it's created.
Yeah, that's what I'm. C to D, maybe. Okay.
I mean, it's already basically kind of started for the B to. Yeah, I mean your C to D because you already created your M more or less. This would be considered more or less a Cypress at that point because you're at a topping. These usually don't work out as well, just because you're on such a bullish area here. But so you're not even a full pledge pattern at that point. So more of a spirit than a quality pattern because you see we did not hit 38 on the pullback here. We only hit 30. So you can call it a spirit one, but technically we should have pulled back down to at least about here. And then this also on the Cypress area here, we really should have pushed up a little bit higher to be a more picture perfect, to be more within the parameters. So we're close enough that I could say it's within the spirit of what you're trying to do. You have crossed your 13, you're pulling back to the 50 off of this. The area of where you're actually going to probably see a bounce and stuff with this is going to be more or less right around this 50% mark, 50% on the daily on the SMA 50, and then you also got your 50% pullback right here off of that zone. So I would look for right around this ballpark probably. I wouldn't actually expect it to go this far. You could look at the potential that it's going to come up to about here because we're holding trend. But the thing is that market starts moving back up, then we could actually see an actual bounce because the earnings report that came out didn't help the pullback too much. But at the same time, we've been trending down with the market also. So if we get a little market push, you could actually get a retest of this 50% right here on this run upside. Because we basically went up to the 61 in the pullback. So once, like I was saying, when we get a 61% ratio hit, we should usually expect it to come down to the 38 because that's going to be your back and forth. So your back and forth is more or less, you're going to see more or less like this type of action happen. This back and forth between these two areas until we decide to actually break it down and break the trend, or we decide to break out and we'll basically be creating a channel. And that'll start probably changing over time with this trend line. Also, you'll probably start getting less and less movements. I mean, or you may actually start extending out eventually for these. But that's basically where you should look for, is basically these two ratios of it actually moving around like that. Because we get down to this area here, you should expect a pullback from your run from here to here to about 38%. Well, where's the 38%? Right over here near the other 38%, pretty close to it, with potential room to 61. So somewhere in this ballpark is where you see the actual pushback. Now, this isn't a perfect pattern, but it's within the parameters of a spirit of it. So the key thing is I wouldn't be trying to, if I was in the position right now, I would have been taking a little bit of profit once I saw this candle, because that's a potential reversal. And we're coming also to previous support, because it has high odds of pushing back up, and it's because it's overextended, pushing up and at least retesting this line it broke here and confirming it wants to stay below that, because it could give you a candle below above that, and then we reverse back up, and then you don't get any pullback at all. You wind up just creating a new trend up here instead. So there's no guarantee it's coming down to this far, especially with that daily candle, the way it's reversing like it is. Momentum's still showing you it's good on the downside, but you see you're also getting into oversold territory where the potential bounce could actually start occurring too. It's not quite ready, but that candle right there would somewhat give me heavy concern. That's why reading candles is really good, but you don't really know exactly what you're going to get until you start forming the third. Because you got three. A lot of times you get 3 down candles, you get a reversal just for the breadth purposes because of the overextension point, which is fine, because if it does that and it doesn't break more or less the new trend on the downside that it's trying to create for this last few days, just kind of pops up in this area and pulls back. This gives you an opportunity to get into the trade, on a pullback, if you're still wanting to take it down. But you got to be still somewhat cautious. I mean, a short below the 13 is the first sign to take it down, but because you're so close to the 50, you can't expect it to start flushing until you start testing the 50 and break below that. Then you're going to start being, where the fun starts getting into it. You got anything else? We got a little bit of echo here, someone.
Can you pull up the post I just did? I just showed on UPS. This was a few weeks ago, actually. So I'm measuring the divergence on the bottom trend, on the stochastic, and then on the chart. Does it matter which one is the new low? Like, for instance, A is the lowest low. Does it matter measuring, so what if does it matter that A is the lowest low on that stochastic being in past tense, or should it be the C should be the low for the divergence to exist? Does that make sense?
You're talking about this as being A here? I mean, I see A up here.
Exactly. Yeah, exactly.
Okay, so this is A and this is your B?
Yeah, C. Well, the C leg is C
okay.
point. Does it matter where the lowest low is at in those two valleys?
It's usually preferred for it to be the newer one to be on the lowest low. Because if you had a little bit of a higher high, that's almost kind of following the same pattern as the actual chart itself. The idea behind the divergence on what you're trying to do is to be opposite of what the chart's doing.
Okay. That's what I was.
That's the key. That's the key thing. That's why we call it divergence.
Okay.
So it still doesn't mean it won't bounce, because if you get it where it's on the high side, you're basically just following what the pattern is actually doing. It's on the chart itself with the candles.
It did bounce to 108.
Right, and so this gives you more. This gives you a better biased opinion that you're going to get the bounce.
Mm-hmm.
Because you're seeing it early on. You're seeing the pressure build up that it's getting ready to give it. I mean, this is a higher probability than if it was actually the exact same as the chart was doing.
Okay. That's what I was getting at. Thank you.
Okay.
Good question.
Okay, so what's the other question? If you're having trouble unmuting yourself, just let me know, or just post in the chat.
You already said that the possibility of, the Monday rally, whether we're able to capture that move or if it's not really a rally. But I mean, all of this is just temporary until more news comes out, about the virus, right? So it could easily crap out, in 5 days, right?
Yeah, this is just a temporary move. It's a temporary fix, basically, because it's more or less where they're wanting to take the stock at and stuff, because we have to follow this large money. We don't have a choice but to follow this large money because they're pushing it or pulling it, one of the two. So once we start seeing their power come through, we don't have the power to go against it. We're just going to get ran over like a steamroller if we try. So the best play is to follow the river current and go with the flow to maximize. And these are the opportunities that you get to make the big cash, because you can follow the bigger waves, because they don't make moves like this on an everyday basis. You see these moves like this maybe once a year, maybe every 2 years, maybe not. And sometimes this much traffic. I mean, I haven't seen this one since back in 18. So this isn't, it's been almost going on, I guess, a couple of years now, 2 years now that we just have this. Well, about a year and a half, I guess you could say. So we can follow their suit, a few times a week, you could say, because a lot of times they don't even really, they're just basically just slowly accumulating over days and days and days. And then the slow buildup kind of catches up and then starts making the move, and you don't even notice it because they've extended over such a longer period of time that it's harder to really kind of get a big picture of exactly what's happening. But when you start seeing massive accumulations like this, you have to just basically take advantage of it, because they don't come by that often.
Well, I've just had the pleasure of watching the entire last week and a half. I got my computer back last night, so I'm truly curious about what Monday will bring. And I'm curious if my computer is going to hold up to the volume, which seems to freeze when that happens. So we'll see if they fixed it.
Well, being on a good platform is kind of crucial when you have massive amounts of volume coming through. I mean, the ticker tape alone can flood systems and choke software platforms, especially ones that are heavily utilizing too much resources on your computer and stuff on it. Some of these firms will have problems just because of the overwhelming amount of customers that they have also. So being with the biggest company out there is not necessarily a good thing, because they could be overloaded. I mean, it's just like anything else. I mean, it's like if you have too many people try to call up a web page simultaneously, eventually the server will give out and stop working because it's trying to do too many commands at one time. And our trading platforms aren't any different. We can't assume that they're always going to work in these massive areas, which is another reason that you got to be careful about how heavy you're loading up, because if you can't get out of a position when you need to, that could blow your account up, because they're not going to come back and say, oh yeah, we had a little problem and yeah, you lost 20 grand and here's 20 grand back. They'll just say, well, we'll give you a few free commissions. Oh, wait a minute, we already given you free commissions. Sorry, have a nice day. They stopped doing the free commissions on a lot of these brokers because they give away free now anyway.
Right. Well, supposedly it was a software difficulty, so we started fresh.
Hey, Doctor.
Yes, sir.
When you are saying that dark pool prints, so is it possible that they are loading up a short position here? Is it possible?
That's absolutely possible. Absolutely possible. That's why I say there's no 100% guarantees here. The biggest thing that I'm seeing that I'm thinking that they may be rallying back up here is because we got positive news the other day about the Fed. It's coming out. And I think they knew this information before the CNBC knew it.
The overall week we closed after this pop-up, the S&P 500 is down only 11%. Since the VIX is up 150 to 135. So VIX is still up 135%. And Dow and Nasdaq both are 11 and 12% down only. So this 11% and 135% on VIX, it's have a too much, like still it is showing that there is a too much volatility, means it's have a lot. So do you, means I know you already cleared it that it can be possible and we have to see the price action, but just for a study, means what you think after that percentage to seeing downside. S&P is 11% only and VIX is 135% up.
Right, and that right there is giving me the indication that the reversal is going to take place, because how many times have you seen that in history?
Means this was I think
we're about maybe 5 times in history this has ever happened.
Yeah, exactly.
So we don't even have a crisis yet in our country. We have a global problem with the supply, but we're not over here coughing yet. We don't have hospitals that are full. We don't have schools shutting down. We don't have businesses that are closed down. So it is a little premature to try to crash the market. This is just a sign of what's to come when we do get this. So it really is time for the bounce. And if you go and look just at a plain Jane, look at the daily level on the SPY. Look how far away we are from overextension just from the 5 EMA. 307. Remember, I always tell y'all guys, the 5 EMA is something to watch for a pullback when we stop touching it with the candlesticks, right? Well, we're at 307 right now and some change. Where is it that I want to go up to? Wouldn't that help the overextension? So when you start seeing things when the percentages going up like the VIX like that, that is a sign of a potential reversal taking place because of the overextension and stuff. Janie talks about this all the time with his RSIs. He does being oversold, overbought. We're oversold. There's no ifs, ands, and buts about it. It's just a matter of when we're going to do the snap, and the snapback to at least some sort of a pullback. And by seeing this type of accumulations happening, gives you the indication that something is about to change. Now, if I didn't see any type of late prints coming through, and I saw all this was just localized prints throughout the trading day, I'd be saying, you know what, they're going to take this thing down further. Because like when we had the prints that happened over here on the 26th that brought us down even further, we had like 3 late prints. That's less than normal on any given trading day. We had massive amount of prints that happened during the trading day at that point. And that's why I'm calling this a major resistance zone. But we hadn't seen this amount of prints come through at this amount of level since we started over here. When we had the drop that Friday, I saw them starting to come in. That means that they started doing this transactions over here on Thursday. We got reported Friday, and that's why we had the drop. Because we had over 20 some odd prints come in late off the Thursday transaction. And this was the result. So anytime I see late prints that are massive amounts beyond the normal prints, that's when I expect that we're going to be they're basically setting up for a reversal because they're trying to hide their position. They have 24 hours to get everything in line. I hadn't seen that, then I'd say yes, we could be accumulating for the drop down to here. Honestly, I think the way the accumulation's set up, because they're not going to want to lose money. I think we could have an outbreak over this weekend. I think we'll still bounce. That's how crazy, and that's how much conviction I got into this. And like I said, I may be completely dead wrong. You may be think I'm an idiot Monday, but
No, I agree, Dark Side, because I was even telling when me and Mike were talking a little bit in January, because we were watching it going into the close, and like I said, we were watching everything bounce like crazy, and it was just like, man, we're gonna gap up like 500 points on Monday, and it's like, what are we? Is it just gonna sit there and consolidate, or is it just gonna continue to rip, or is it just gonna sell off?
I thought it was interesting that TVIX started selling off before the SPY ripped.
And they sold gold, like we were talking about gold, and I'm like, I was listening to a couple other guys on TV and stuff like that, and they were basically, people were selling their gold positions to make margin call or whatever, and they're buying up all these positions. I mean, doesn't that kind of necessarily give you the idea that they're gonna push the market back up?
well, gold is its own merit. Sometimes gold will get off. Pull up like JNEG and stuff. Sometimes gold will get off kilter than what you expect. Because you expect gold usually to go up when the market goes down, and vice versa. Well, the problem with gold is that gold was already so oversold in the first place. Overbought so much, and that's the reason why we were more or less getting a correction. Gold is basically just there for the wave in case something happens, you can convert it back into dollars. Really, the true measurement of figuring out how the market's going is paying closer attention to the bond network and the stocks versus on the two, because the bond network is more or less, it's happening with the government stuff. So you pay attention to what's happening on that side. It'll help you a little bit better than paying attention to gold. Gold's just kind of an old way of thinking. Well, if the government falls, I got gold. When the new government comes back in place, I've got currency that I got basically gold I can turn into the new currency. That's basically the only factor on that. And that's why it's always been kind of the safe haven. But every time gold has been dramatically high before we've had something like this, we've had these type of pullbacks on that. You don't quite see that in the bond side on there. So it's a little bit easier to detect off of the bond side than it is to play with gold. Now, gold was already lower, and then we had the market started pulling, then yes, I would expect gold to go higher.
Well, no, I was just saying, if you were a hedge fund and you had all these stocks that were tanking, and gold just had this huge run, a lot of these guys were selling their gold off to make for new cash that now they can dump into Nvidias and Netflixes and all these Teslas and all this kind of stuff to kind of get this rebound back, going back to the highs again.
Yeah, I mean, that's a good theory too.
On the note of different institutions, so you were discussing how these institutions were selling along with gold, etc. So which institutions actually come first? Like, you have banks that are moving first, but then you have the funds that move basically with the banks or slightly after. But
I'm having a hard time hearing you, Jasmine. You're kind of fading in and out on me.
Okay. Is it okay if I try with Discord?
You sound better now, yes.
Okay. So you have institutions and then you have funds, right? So I mean banks and then funds. So you have banks that are moving first before everything happens. And then you have the funds following along. How far is the difference, like time-wise, between one or the other? Because I can't believe that the funds are that far behind. I can't believe that some people actually sell their stock when everything is dropping, but I can't actually fathom the idea that funds are losing money. Unless like someone actually made a huge mistake.
This is basically the banks that are doing the biggest pushing on this. Your Citibank, your BFA, Goldman. These are the big institutions that are basically moving the stocks more than anything else. The funds usually are the hedge funds and stuff are more, they're just following suit more or less. You look at more or less that they're just setting precedents on the market, making a market, going back and forth, and they're buying and selling between each other off of this, and they're also making the underlying stocks move back and forth by this major pressure movements on the dark pools. So I would put more weight in paying attention to like what Citigroup is doing than I'd be worried about some side hedge fund or something like that.
Yeah, but they do sell like slightly after the banks, right? But not far behind.
I'm not following what you're trying to say.
It's just that I was thinking because, of course, my family has some other investments, and of course, it's that I believe it's the people that lose the most money when this kind of corrections in the market happens, right? But banks do not lose that much money because they're basically creating the move, and then you have the hedge funds, which are basically the second largest amount of money that move the market. So how far behind are they from the banks? Because if the move has already started,
each hedge is going to be based upon how connected they are with the industry in general. Some are going to be dramatically behind, and and some of them are going to basically have the insight to what's going on. So this depends what it is.
Okay, that's okay. Thank you very much.
Can you hear me?
Very lightly.
That gap up when we gap down from 334, that will eventually be filled at some point in time, correct?
The 334 gap up.
Gap down from there.
The gap down to do 100% gap fill.
Yeah, that will eventually be filled at some point, correct?
Yes. I mean, obviously, we'll eventually get back to that level, but it's going to be a difficult path. We basically have now, because of the drop that we've had and how long it took us to get up there in the first place, and because of all of this fear with the coronavirus and all that, it's one of these things of we're going to have to gap up there fast, and I mean really fast, almost as fast as we drop down. So within, I guess, the next week, you'd say, or we are going to probably look at it being months before we'll probably see that number again, if not possibly a year. It just where we're setting at now, I don't think we're going to be back to that number until this virus is behind us.
Okay, because like when we gapped up, like on the ES, when I was watching that, we left that gap at 29.40, and I know people were always talking it's got to get filled, but it took quite a few months for us to get back down to that level.
I mean, when we were last time at this level was back here in October of last year. So it basically took us 4 months to get to the top.
Yeah.
So we can't expect, like I said, because the market's so volatile right now, there is the possibility of the snapback within the amount of time we dropped. Highly, highly unlikely, because it took us 4 months to get there in the first place.
Yeah.
So I don't really expect us to start going any higher than around this area here before we start seeing a bleed off again. I think what we'll probably wind up seeing out of this whole system, I think we're going to see a harmonic pattern develop. I think we're going to see somewhere around here, we'll probably start seeing something like this develop, and then we'll get the ultimate demise. A bearish pattern will start taking place.
Yeah.
I mean, how much do you think the elections coming up and so on and so forth, do you think we'll have your pattern that you have going into the elections type of setup, and then it could fail either after or slightly before? Is that what you're, or is this just based off all of,
this is based strictly
itself?
off the virus. So until the virus gets away from us, we got to get the virus behind us. Once the virus is behind us and we're free and clear, which is probably going to take 3 to 6 months. Well, we're 7 months away from the election.
Right.
So I don't really see us going back to the high point, and breaking through that unless Trump gets reelected in November.
Right.
And if he doesn't get elected in November, and whoever comes in place for it will probably not see this number again. Not for a while, anyway.
Right.
I don't expect the market to, if he winds up getting out of the, getting kicked out of office and someone else takes his place, whoever it is, I don't expect the market to tank, completely fall apart. I just think it'll be the end of the. I think I think we've seen our topping at this point. We'll just start slowly drifting down until we see a stabilization and start. Because when it comes to any new president, it doesn't matter what party it is. We got to kind of see what they're going to do, more or less, economic wise and stuff.
Policy change.
So
forth, yeah.
Anytime you have policy changes, that becomes the unknown factor and stuff. And once we start seeing who's actually going to be a candidate that's going to go against Trump, we could start seeing some volatility on that based upon how close they are to potentially winning.
So then would we want to focus on particular sectors that, like banks, for instance, if of one particular person over the other, or healthcare, that kind of stuff? Probably maybe start looking at those kind of sectors for plays based on, potential election.
Yeah, based upon whatever their policies that they're chatting about, it's going to make a difference, and it changes how close they are to potential winning. Yes, absolutely.
Okay.
I mean, like if Bernie gets goes against Trump, then healthcare would definitely be on the table because he's talking about Medicare for all. So it's something that would definitely be on the table. Probably start seeing Humana and United Healthcare start moving around quite a bit. It happened back when Clinton had a chance, because Hurley's has always been kind of with the healthcare thing. She stirred up the healthcare back when Bill was in office. When his first year that he got in, she started stirring up the healthcare system and stuff, and that's when our insurance rates started dramatically increasing way back then. So it's makes a big difference in who's in there and pushing their weight around.
Dark Side, is there any time where a retail trader won't be able to trade, like because the market's messed up?
Are you talking about because you're having software problems? Or are you talking about because the industry changes? I mean,
overall, like it's conditions are so bad that retail can't even make money in those stocks.
The only way I can see it becoming a big issue is if we go too much into high frequency trading systems and it goes exclusive to that, then it may be over for us at that point. I don't see that happening in the near future. Probably we may be 10 years out from that, to where they completely take control. Right now, I think we're in the best times ever for an individual trader, because you have more knowledge and more tools available to you than anybody has ever had in history. I mean, you actually are now even with these institutions and these hedge funds and stuff like that, because you have so much great tools available to you to be able to look at for investment purposes and stuff, and live data coming in and stuff. Now, of course, they have their little stuff like that, but if you go and look at some of the stuff that these guys are using and how old their systems are, are, we're light years ahead of them on some of our platforms on what we're doing, you know. So they do have the bigger money to push us around, but they don't necessarily have as you can't say that they're smarter than you are, because that just basically it just comes down to they have more money than you do, you know. And so it's just more or less, as long as you are doing your research and you're paying attention and stuff, you're in one of the best times in history right now to be able to have control of your destiny and how things are going. And it's just a matter of interpreting, you know, where the money's moving around and how the system is, you know, basically understand how they, you know, shake you upside down and knock the coins out of your pocket, because they're, you know, doing the back and forth push and pull all the time. And once you start interpreting these moves and have that little bit of an edge, then this is not that difficult to do. But if we ever get to the point where high frequency trading takes over 100%, then, and we got to be programmers or high frequency systems, that's going to be a game changer for us. But we should be embracing high frequency trading and enjoying this there, because we have more volatility in the market than ever. We have greater ranges in the market than ever since we've gone to computers and we've gone to high frequency trades. They are creating markets and stocks that would be going sideways, that would literally be just flat and dead until like an earnings announcement came out or something, or some negative news popped into the media about a specific stock. It would just be flatlined. And that's the way it used to be. If you go back and look at the trading around the 80s and stuff like that, a lot of these tickers were just flat until there was some sort of news that came out. Well, the frequency trading is allowing the stock to move on a day in and day out basis, because they're making monies from fractions of a cent. And you're over here just being able to play it, you know, off of it. And of course, News Catalyst is still going to be, you know, always be the best thing to play, because that's going to give you your greater volatility of greatest ranges and stuff. So you need to try to stick with stocks. They're either hot, well-known hot enough that they have great ranges in them, where they have news or not, or you're playing just stocks that actually have a catalyst on the day, one of the two. Does anyone else got anything?
Well, I don't want to. Go ahead. Just real quickly, I don't want to sound like doom and gloom, but you know, I've also heard that they expect, you know, if this virus does get under control within, you know, by the summer or something, that a lot of times they'll have a re-breakout in the following fall, which could actually be worse. So, FYI.
Okay, doom and gloom.
So, Dark Side, what if one of these biotechs comes out with a vaccine or a drug? Would that bring the market back up?
It would make that stock pop, but you got to think of the mass production that has to be put out. If one company came out, I mean, or even if it's a small company, and say Pfizer, Johnson & Johnson bought them out and took over because they got mass production facilities to be able to put them in place. You still got to look at your year out from probably getting enough out there, you know, because the process of it all taking place and being able to cover everybody that would need it would take probably a year. And then you got to look at the financial cost of it. Okay, you've got people that have insurances that would cover it, and you got people that don't have insurances. It's like, okay, would you just give it to them for free? What about the countries around the world that have nothing? You know, do you do a humanitarian need and give it to them for nothing and stuff? So when you look at a global scale that it would seriously need to be deployed on, you're at least a year away from any type of thing, you know. So the initial news coming out is going to make any stock pop, but the market's going to basically be looking more at how it's affecting the commerce. Like China's shut down. It's like a ghost town in some of the streets over there. And it's like, okay, we're expecting shipments to come into our country on average about 5 or 6 weeks after we order something. Okay. The boats should be at this point, we're at the point that these boats should be showing up at customs right now with the cargoes that need to be put into the shell, get it into through customs, get approved, and get it to the people that delivered to the customers that ordered it. And we're just now starting to see empty ships coming in. That is when it becomes a problem economically, because now we've got products that can't be sold that people want to sell. I mean, everybody wants their next iPhone or Android phone, and now they can't get it. And there starts becoming shortages across the board for everything. That's going to affect each individual company, which creates a cascading effect. If it lasts too long, that layoffs will start taking place, which layoffs creates a cascading effect of people have no money. They won't spend as much money. Entertainment will go out the door first, and then it'll just turn into what you absolutely have to have in order to survive. And so more businesses will start going out of business or start getting dramatically hurt. More layoffs will start occurring. So it's not about the vaccine. It's about the economics of it all, how it's going to create a cascading effect that we got to worry about more than anything else, because this isn't a virus that you have a 100% guarantee you're dying over. It's basically just another form of the flu, and you have a chance of recovering if you're somewhat healthy. If you are probably already have medical issues, you have a chance of having some severe problems. We don't have enough facilities across this country to house everybody that gets sick all at once. Just like we don't have enough firefighters to put out fires if the whole city starts burning, or enough police officers to cover, a massive outbreak of, lawlessness. We're not structured anywhere on this planet to be able to take care of anything that becomes an overwhelming amount. And we just got to hope that we don't to get to that point. And it's just the movement in the market itself is based upon the overall sympathy of what's actually going to happen across the board, not because of one company making a vaccine. It's all going to be about the economic problems that we've got, even if the vaccine comes out. And how long is it going to take before we're going to recover and get back to normal, is what's all going to have to be priced into the system.
Well, with these high runs that like Apple and Nvidia and all these big tech companies just had, if obviously with demand or supply being probably slowing down and so on and so forth as far as deliveries is concerned, how do you try and price in like earnings and stuff like that come next quarter? How do you try and play that kind of stuff? I mean, I know they already are guiding down and so on and so forth, but what can you expect out of a company that was supposed to be making X number of billions of dollars or whatever, and then they're like, shave 20% off that number or 10% off that number?
Basically the same thing happened to Microsoft last week. The same thing that happened to Apple. About a week before that, you're going to see a drop. You'll see some stabilization to a certain degree, but the initial guidance coming out, they're going to take a hit.
So then these extreme pops that we were getting in this bull run that we've had are probably going to be not as likely, because unless, they weren't affected as badly as they anticipated.
I mean, anybody that's got something that is being made anywhere where the infections has is going. I mean, you're foolish to think that they're going to be able to meet their guidance report. I mean, so the odds of these companies having much of a push is not going to happen too much with that looming over their head. Now, the ones that are being upfront and honest, Apple was one of the first ones that came out with that information, and Microsoft's right behind them and stuff. They're just getting ahead of the curve because they know they're going to take a hit, but they're trying to get ahead of it before it becomes a big shock factor and it winds up hurting them even more. They're just telling people ahead of time, man, if you believe in the stock, you're going to start looking for dip buying opportunities. Because, I mean, these type of situations are like 3 to 6 months. Usually you have the infections going in place, and then you still got another 3 to 6 months before you start recovering from that. And then, of course, if it's something that can reoccur, you still got that cascade effect until, the vaccines or whatever is going to cut back on the actual occurrences. So this could be something that lasts a year and a half if it gets that big. But we'll recover from it. I mean, it's just a virus. I mean, it's going to hurt us economically, but humanity's gone through how many viruses throughout the creation of time, and it's managed to pull through it. This isn't the doomsday virus. This is just basically something that's going to hurt our wallet.
Gotcha. So, I mean, with all that being said, assuming that we don't get some crazy number in the U.S., we're saying whatever more are infected. If Monday morning we do have a gap up, what kind of things should we look for? Should we look for the pullback test and then kind of continue higher? I mean, you look at NVIDIA. I mean, the volume came in on that thing was just insane. So, do we gap fill back up to like the 290 area where it had that gap down initially on the daily?
You trade NVIDIA just like you'd trade any other stock on it. I mean, I'll pull up the NVIDIA because I actually was analyzing this one because I actually have a position in it. The NVIDIA should see a push up here to about the 50% because we're already breaking above the 38. So I'm looking for a push up to the 50 right up here, about 279 or so, with room to 288. And that's about as much room as you'll probably see it occur before it probably starts, grinding back a little bit. I don't see any stock that has made the major plummet going all the way back to where it came from last Friday. Not at this point. So, I mean, especially a company like NVIDIA, even though they're really strong right now, they've got to have a capacitor or something that's sitting on the side of that PC boards they make that is made in China. So the only thing I can say about NVIDIA is if they still have an overwhelming supply that they haven't gone through, then, I mean, that's going to help them a little bit. Anybody that's overstocked is going to weather the storm better than the companies that are winging down their inventory because they got a new product coming out to replace it. Those are the ones that will be getting hit probably the hardest because if you've got a healthy amount in your warehouse that can withstand 6 months, then you're fine. But the average business probably doesn't have more than 30 days inside their warehouse. 30 to 45 days max, because they know they can get their supplies from China on, within, 6 weeks usually or less.
The Best Buy should be, or Bed Bath & Beyond should be good because you have tons of stock.
Yeah.
So, I mean, coming up to this week, what would your main focuses? What would you be kind of eyeing up more than anything? All these tech stocks that just got kind of slaughtered, or across the board things like Carnival Cruise made like a nice reversal too, that kind of stuff. Airlines maybe.
No, I wouldn't be messing with anything that's going to be directly affected by the virus, like airlines or Carnival, because that's going to be a short-lived bounce. I'd be more inclined to play stocks like NVIDIA, Apple. Roku seems to be holding well. I mean, Roku market is going down, and pretty much this whole week, Roku has been basically just somewhat stagnated here. So let's go out to the daily. Roku's pretty much been on a, within a range of a grind over here because we started off with. I mean, we're really range bound right there. Market's been plummeting, and it had its big sell off from the earnings report, but it is stabilized here. So not that I don't see Roku right now as a good entry. I think it's a little bit still in the grind session, but I'll be definitely keeping an eye on it. But any ticker that is defying the market somewhat, Tesla, it's a high price stock, is going to have some volatility inside of it. So just anything that has range in it would be the ones to work with. The ones that are directly affected by negative problems with the virus, I don't think you're going to have investors come into those as much, even for small scalps, because at any moment they could come out with something more negative. So I'd stay away from Carnival and the airlines unless you're just going to scalp it intraday for a 10-minute play or something like that, but definitely not a swing. Unless you're, once we see a topping and start seeing things could start pulling back, then I could see the swing in those. Of course, anything that is dealing with the vaccines are going to be hot. So, and what's really crazy is you look at these stocks like the CODX, the market, it goes up, the market's going down. As soon as the market stabilizes, it pulls back. I mean, you look at all of these and it's like, what the hell is this all about? You know, it's like the market's going down. These are going up because these are companies that have something connected with the virus, you know, whether it's vaccines or masks or whatever. And now all of a sudden, because the market is stabilized or considering to rally a little bit, they pull back. Well, the virus isn't over. Where's the logical sense that these companies should pull back just because the market decides to rally up a little bit off of, you know, the feds are going to come in and help us with some interest rates?
That could be an extension thing, you think? Because look at Moderna, for instance, mRNA had a nice pullback. I think Bullberry even hit me up about it the other day. I mean, thing got so extended, it's pulling back, testing the EMAs. I mean, this thing could actually base out here and then continue back higher if these concerns are still relevant here in the future.
All of these concerns are still, that's what I'm getting at, is that these movements are happening because the market's going it's doing the complete opposite of SPY. And why is that? Because that's just the way the computers are kind of programmed. That's the way traders are thinking. Oh, it ran up with the market. The market's pulling back. Let's get back into it. So what they're doing is with these stocks that are pulling back, that are connected with the virus in any way or form, are actually creating good dip buying opportunities. Because until they say, oh, well, virus is done and over with, there's no more threat taking place, they still have a chance of continuing to grind higher, you know?
Yeah.
Just like, I mean, the airlines and your cruise liners, any entertainment, Disney with their theme parks. Disney's going to be a little different animal because it has a massive problem with the theme parks with this plague. But at the same time, that's going to probably take a hit across the board because a lot of their revenue comes from the movie theaters. So even though they've got the streaming service and they have ESPN where you can sit at home and watch TV and stuff, that's not going to be really enough to save the stock. So Disney would be taking a hit, things like that.
Yeah, I posted a chart on Disney. It has a harmonic. Be really sweet though if it got down to the 100 range because that's a perfect shark.
What time frame you looking at?
I posted in chat. It's daily. That pullback was to the 85.
Yeah, that's what you're saying.
And that 100 would be sweet spot.
So we should probably see Disney rally up a little bit with the market Monday, but ultimately it's probably going to pull back down as the virus starts breaking out more and more and more. So, I mean, because it is kind of starting to break the downward trend line a little bit. It's trying to break it, right into the close. So we'll get a little bit of a pop. Disney's got so many things going on with losing the CEO changing hands and this virus and everything else. I mean, Disney will be a great dip buy eventually. I just don't think it's seeing its lowest point it's going to be at until we get the virus is done and over with. It's not going to affect us, and then we'll start seeing Disney start reclaiming itself once again. But we'll have the most volatility when it comes to anything that's in the NASDAQ versus anything that's inside of the NYSE. It's just nature of the beast that NASDAQ's the more popular exchange out there. So sticking with your pretty much the hot stocks like your tech sector is going to be things to really be paying attention to for these bounces that's going to take place and everything,
Wouldn't it also make sense to pay attention to the ones that still had great earnings, like NVIDIA and TDD? I mean, they really had great earnings. I think would have a better chance of rebounding.
Absolutely.
Or faster rebounding. Okay.
Yeah, absolutely.
So for NVIDIA, you said you want 289 to gap up to 289.
Well, yeah, but I'm shooting for 50 just to start with up here at the 278.99, 279.
But eventually, right?
Yeah, I would like to see that point. As long as we don't start getting the market pulled back anymore, we got a shot for that. But I'd like to see up here as early as Monday the 279. I think we'll probably start stabilizing around that area. We do have a little bit of a harmonic pattern kind of developing here, so that this can pull back before it pops back up if it wants to. It's just that one thing I do like is how it closed out. It stays so extended out. A lot of times that makes it where these patterns don't work out so well, but it doesn't mean a whole lot because the traffic was light going on the close versus we could just snap. But if the market pops up in the morning, that should help NVIDIA push it up.
I was thinking of getting some April calls. What do you think?
It's not a bad idea.
Okay, because it's going uptrend, right? It has an uptrend. It's holding.
Yeah, I mean, it's if you're just playing it for light pullbacks, but I mean, if you're trying to hold it to expiration, then I wouldn't buy them naked. I would just buy, a scalp.
Yeah, scalp. Yeah, that's what I was
that's fine.
For like a week or two, is that okay? About a week or two.
Well, I don't usually go naked on any plays that I hold overnight. I just usually just use strategies.
Okay. Got it.
Take a look at TDD. It actually pushed when the market was pulling, but right now it's on from its all-time high at the 61, that pullback, the retracement on the hourly.
Yeah, I like this one too. I saw it the other day. Friday, I was looking at it.
Hit the 61 on the down leg, and then also is hitting the 200 on the hourly. Kind of has that market structure look to it too from your class. Brian, if you're talking, I think we can hear you.
Oh, sorry. It's at the 61 off of its basically its gap fill. You got the 200 in the way. You are at back to the 23 from its previous run. So this is an area for potential pullback. Normally I would look at doing a short position right here for the pullback, but because the market may rally Monday, I'd be a little careful in trying to do the short. What I'd like to see develop out of something like this would be, you know, this type of a pattern kind of take place on that's what I'd be kind of looking for. But you got to be careful with the market possibly pushing, not the TTD as part of the SPY, but just the sympathy in general could be enough to push it up to this area here before it decides to give it up. It just depends on how well it wants to hold.
Which could
these
give you
levels.
a butterfly.
Right.
The other thing too is looking at their ratings and stuff based on all the different companies or whatever, and they're all around 300, 310, 270, 265, 208. So I mean, there's not, I don't know, not much more than 310 that I'm seeing. So I can't imagine that there'd be too much range to the upside. So maybe that play would work out on the downside and then bounce it up.
If I didn't think the market was going to pop Monday, I would be looking at a short position right now for sure. Domino's Pizza. I like that. I think Domino's is probably gap filling a little bit too much already. So I'd actually like to start seeing, clean all this junk up here. Let's see, we're pulled back around 50% right now, so could start seeing a little bit of a curl, but we could have also room down to the 61 before it's over. We still got a pretty strong downtrend on channel. We are starting to see momentum starting to slide back in a little bit, and we are starting to curl up a little bit on the overbought. So this does give us a little impression that we could start seeing the basing bottom possibly starting to come into it. On that, on the hourly chart, daily chart is overextended dramatically, so you get that rubber band snapback. You've got a candle that's basically setting up for an undecision, but more or less when you usually see this at the bottom like this usually means that we'll probably push back up on the next candle. So I would kind of look for Domino's as a possible dip buy right now, opportunity. Home delivery, pizza and stuff like that without a major outbreak is probably going to, with a light outbreak, will probably be a good thing for Domino's. More people will probably just order food instead of going out, obviously, to restaurants and stuff. If we get some craziness happening where it's like having a hurricane show up in your local town or something where everything just shuts down and Domino's closes down because all their employees are sick, and then they will take a hit. You know, so just depends how bad the outbreak turns into. They're not outbreak proof because you can't have sick people making your food and you can't have sick people delivering your food, you know. But if it's something that's light and it's not affecting everybody and it's not going across in the whole nation, it's only in certain cities, it could hurt their underlying and overall like their guidance because of they're taking a hit in certain areas, but overall it's going to still could keep the company working somewhat. But if we get a complete nationwide shutdown for some crazy reason, which I really don't see this happening, but if we do, then they're not virus proof at all. No more than saying DoorDash or Grubhub or Uber Eats would be, because they're kind of in the exact same scenario. Of course, you'll have probably a sick driver show up at your doorstep, you know, rubbing his snotty nose on the bag that he's handing you on the food and say, "Here you go, here's your food, have a nice dinner." But thing is the restaurant's going to be open for them to deliver it or not.
Hey, Darkside.
No, we didn't talk about Tesla. Oh, Tesla. Starting to get a bullish pattern developing here a little bit. Not really a great one, but we're holding trend here. Tesla does have the ability to slip down to the 570-ish range area here if we wanted to get more downside on it. I think it's getting to the point where it's a little bit on the over. Well, we were over here, right in here. It's already starting to correct itself. So we're in the over sold territory. We're already starting to get that cycle bounce. Now we're getting back to the top, which that's not super great as far as showing that we're overbought now. But at the same time, if we start seeing this pull back on this chart and we start seeing the candles moving up, that's divergence, and that's what we want to see. That would be a very strong indication that Tesla could bounce. I don't think Tesla's done trying to make its way back up to $1,000. I think it's got a deep, it's going to take a little longer than they expect, just because we've had such a dramatic pullback. And you see on our daily chart, we came down to the 50. We did break the trend overall that we were kind of on that slow upward trend until that earnings report came out. And since the earnings report, we've been really whipsawing around like crazy off of that. And we're basically broke that trend. And so that's where we've had too much of a pull down. We're hitting the 50, but we're overextended dramatically right now from the 5. We're still showing strong momentum on the downside, and we technically have not gotten a complete curl, even with this showing that we're ready, that we're completely over in the oversold territory yet. And this is why I was saying that Tesla still has a chance to move down to about 572, I want to say, somewhere in that ballpark is what I was calling out, that we could have that potential pullback off of that level. So with Tesla, we need to be, there's no daily pattern that's really clean for a rally. The hourly has a little bit of one for the rally. So we're kind of in that point where you just got to kind of play the price action in general of what you see. I don't think, I'm not grabbing that right. Am I hitting the wrong button? Trying to delete that. There we go. I think Tesla has the ability to reclaim. I just don't necessarily think this is quite the right time. Let's see what we've got actually in measurements of this pattern. See the kind of a low area. High, we're pulling back here. This is actually probably the lowest point here. You see, it's almost 100% right there, isn't it? No, this is actually higher. I think I hit that right either. So what do we have here? Yeah, we got a pattern. So yeah, you have basically an opportunity to run this back up. So at that point, I can grab the line, right? You can look for Tesla on its little pop to come right back up to the 38. Well, where's the 38 at? The trend line it just broke. So this is what I'd like to see Tesla actually do, just pop and come up to this area here. And at that point, we'll probably have some problems. So probably around 734 or something like that. Now, of course, once you hit that, and if you break through that trend line for a continuation push, you look for your second PT being about 810, right around this area here. Once you see the 200s kind of starting to curl in the hourly right around that area. So I would look between 734 to 810 at that point. And at that point, we're going to have to start looking for a whole new pattern. So somewhere in that ballpark at this area. This has been heading down south with the market also. When did the demise start? Started the exact same day that the SPY started dropping. Tesla's not part of the SPY, but it's kind of funny that it's actually followed the SPY this go around. So if we have a rally, I'd say Tesla will probably be one of the ones that'll probably give us the greatest range pop to start with. And we've got a pattern that is actually developed there good enough to create a bullish move. Let's start off with it.
side?
Yes.
There's a couple bigger stocks reporting earnings this week coming up. If we can go through a couple of them.
Sure. Which one you want?
We got Costco.
Is it their earnings or is it their sales? Because they do a report every 30 days.
It's earnings Thursday after the close.
Okay, that's what we want because they do sales every 30 days also, and that usually makes a major move too. Oh yeah, here it is, earnings. Okay. March 5th. Okay. I think Costco's been dropped way too much here, just like the market has. So I'd like to see Costco start bouncing. We've had okay earnings from them for a while, but you see there's been no major moves off of their earnings. Every time they have an earnings report, it just has a small amount. It's not one of those things that just goes crazy on their earnings reports. And the reason why that is because they report every 30 days, the sales, and then we see a little bit of a move about once a month off of it. And that's what's kind of keeping Costco from making these dramatic swings. This is probably the biggest dramatic swing I've seen Costco do in quite a long time. So I'd like to see them come out with something positive to bring it back up. But that Beijing warehouse that they just put in was a huge hit, and they're taking a hit now. It's now that everybody's sick. So, I mean, because they were literally selling out of everything in their store, you know, when they opened that place up. It was just because there's nothing really like that over in China, and so they just couldn't keep crap in stock. I think it's going to continue staying a hit once they get back to business over there, but they may not see that reflected for the next 6 months because of this hit they took. I think technically we're just oversold too much on it right now. We should get a little bit of a bounce with the market off of it. And when it comes to the earnings, I'm going to be a little fearful of their guidance because they took such a big hit here. I got a feeling that their guidance, I think I remember seeing something when they did it was something about their guidance that came out recently also. So they may just come out and say inline guidance, which is basically just reaffirming what they've already stated. But I'd like to see Costco come and get a bounce up here to the 290-ish, room up to the 300. It has a hard time at 300, so I don't expect more in the gap to 300 off of it.
And there's Burlington, BURL. I think it's made some pretty wicked moves in the past.
Yeah, the only time to really play this one's during earnings. You can see it makes dramatic moves during its earnings reports. Every earnings report, it does some sort of huge swing up or down depending on what they report. So this is definitely one to be looking at for some range in it. Does look like we're getting a sell-off going on earnings. Looks like we are breaking trend a little bit here. So we need to get this thing to kind of start basing a little bit. And it's all going to be based upon whatever their report's going to say. I'm not going to have a biased opinion on either direction because this company goes both ways quite a bit. I don't really. The only thing I can say is that they were bigly, very known for the coat factory back in the day. They kind of just changed it to Burlington, but they used to be kind of their co-sign was the coat factory, and winter is probably their best time of the year because that's what they really sold a whole lot of. They kind of changed over years a little bit, so I'm not really going to take a call out on it to say which way it's going to go. But where we're currently trading at, I think we've gone down a little too far on the downside. So I'd like to see it start basing here for a little bit of a pushback off of it. There's no clean pattern here really to take for this opinion is just more or less just because it's just been extended on the downside move since the market has pulled back. So the market pulls back, this will be one that'll start sliding back up a little bit. Their report display whatever their report states.
Okay, what else? Zoom reports Wednesday after the close.
Zoom has been disappointing to me. The last few quarters and stuff, because we get the IPO, we had the nice push off of that, but ever since then it's been just bad report, bad report. Maybe they finally are coming out with a good report. I think the Zoom is a good stock when it comes to the problem with the virus, because that means more people will be doing video conferencing. I mean, even my wife is talking about she's the assistant superintendent for a school district, and she says that she's in discussions right now with GoToMeeting and other type of services right now to continue doing classes for the children on some sort of video conferencing system in case of a major outbreak. They're using that as a backup contingency to keep the education going. So Zoom is going to be in the cards for they'll probably benefit from the virus because more people will start staying at home and doing their work from home.
Also hit the first PT and the harmonic in the daily.
It's got a nice little healthy pullback here. We stand on the big picture though.
It's a crab pattern.
Yeah. So we actually should have a little bit more downside then. Yeah, I see what you're saying there. So hit the first PT, so room to 85, 81 if it wants to, but got the 200 is dealing with on the hour, and what we got on the daily. Yeah, daily, just a huge pullback candle is for profit, so it's still a strong upward trend. So, I mean, if they can come out with some good guidance and come out with some good report, then I think Zoom's actually got room to start running. We may have another Roku starting up. I've been really disappointed in this stock the last 2 quarters because I was really expecting more out of it because it was like that $100 just seems to be something that just had hell to get over. Now that we're over the $100, I don't really want to see it give it up. I like to see 100 be the curl and for more upward movement on it because I want this to turn into another Roku. I think it has potential to do it. So I would just pay attention to the guidance, and I would hope that they would have good guidance just because if this virus does take in, I mean, that should give them positive guidance. But I don't know all their financials. So just right now, look at it as kind of resetting at this point. Need to start seeing a little bit a new pattern because like Purdue was saying, we've already gotten the pattern pullback right here. You see the pattern he's talking about here. So we're in this ballpark. So that should have that pullback. We've already hit the 38% already. 61 is doable, but unless they're trying to sell it off going into the earnings report, I don't think we'll necessarily get it just because the 200 on the hour chart's kind of in the way right this moment. So this is not an area to actually enter a stock position unless you start seeing the 200 breaking, take it down to 61. Other than that, you just need to kind of just wait for it to grind out, see what the report is. We're going to need a whole new pattern developing off of it.
Okay, and then there was just one more I was looking at, Splunk.
Oh, is that SPUNK? looks like we got the same type of pattern here. It looks like it's already completed itself for the last quarter. So we're trying to develop into something new here. It's just not quite ready. We have broken the trend channel on the pullback. And it does look like we've pulled back enough. Got a 50% pullback here. So the key areas right now is this 38. If we get above 38, we'll have that pop. If it stays below it, then we'll have more downside. So it's kind of in that sweet spot right now. Let's kind of keep an eye on it.
Yeah, next week we got some really good ones. Target, AutoZone, Kohl's, Nordstrom's, Ross, Dollar Tree.
Target dropped below $100 the other day. I thought I saw it.
Okada.
Oh no, it's right at 100. Target's breaking the downtrend channel now. I like to see Target bounce here just because I think that $100 is a sweet spot for it. I like to see it kind of bounce off of that, kind of push back up, retest that trend line. Because they've had pretty good quarters. This was probably their best quarter they ever had right here. But they've been pretty consistent this year with meeting expectations and beating. So I think this pullback right here was they were already pulling back to previous levels because they had, I forgot what it was. There was some sort of news that came out on Target that pulled them back. And then, of course, the market pullback made it worse. So I think Target will rally back up with the market when the market rallies back up slightly, at least to retest that trend line. All right. Anyone else got anything? It's going over a little over 2 hours right now. So.
Yeah, I'm not seeing anything else. Appreciate it.
Okay. Well, y'all guys have a great weekend, and let's get ready for next week. Ought to be another fun week. We can make another history here.
Awesome. Thank you.
All right. You guys take care.
See you guys.
You too.